So this is Mark Sobel, U.S. Chair, OMFIF. Today, I'm delighted to be joined by Vince Reinhart, Chief Economist and Macro Strategist at Dreyfus and Mellon, to discuss yesterday's FOMC outcome and current monetary policy issues. Vince is responsible for developing Dreyfus and Mellon's views on the global economy and making relative value recommendations across global bond markets, currencies, and sectors. He's had a distinguished career at several financial institutions, think tanks, and was a longtime senior Federal Reserve official, including director of the Division of Monetary Affairs and secretary and economist of the FOMC. I'm also pleased to be joined today for our discussant by my friend and colleague, John Fagan, co-founder of Markets Policy Partners. John was director of the Treasury's Department's Markets Room from 2014 to 2018, and before that, he was a leading Asia portfolio manager on Wall Street. So I plan to put some general questions to Vince to kick us off for the first 20 to 25 minutes or so. Turn the floor over to John for up to 5 minutes to comment. That portion of the discussion will be taped. I will then turn to the audience for an informal off-the-record discussion, which will not be taped. Please submit questions via the chat function and or flag that you wish to be called on, and I'll probably turn to you to ask questions. So Vince, welcome. Let me just start off with the obvious questions. Before we dig into detail, what was your overall take on yesterday's decision statement, press conference, and dot plot?
So I think it was a modest policy mistake wrapped around a larger communication error. That it was odd to keep policy on hold after 10 successive meetings of hiking, given the intermeeting data, that the economy's got some momentum, that resources remain taut, and inflation is stubborn. I can rationalize a pause, but not the way Chair Powell initially rationalized it. He said that, well, 6 weeks, we'll get more information and the decision could be better informed. But if that were true, then what information did they get that led them to rise up their dot plot to think that 2 more quarter point hikes were appropriate in 2023? That is, they were confident enough to revise the outlook for the next 6 months, but not confident enough to actually act. I think that was the problem.
That was a very pithy discussion. So the where do you think we are headed in July and beyond, and then we'll dig into some of the macro details?
Sure. So again, the economy's got momentum in the sense that we've been adding more than 300,000 workers on net to payrolls. The unemployment rate starts with a 3. That's under everybody's estimate of the natural rate of unemployment. And inflation has come down, but it's been the flexible parts of our economy that's done most of the adjustment. Inflation in the sticky part, in services, has been much more sluggish. And as historically is the case, that takes a while to work its way through. So they've got more work to do. They left the impression, a very strong impression, that they'll tighten by another 25 basis points at the July meeting, that this was not a stop, it was a pause, perhaps it was a skip, although I think Chair Powell thought that might have been a little too undignified a characterization of what the Federal Reserve does, because he immediately disavowed the word when he said it. So I do think they'll most likely raise the funds rate a quarter point at the next meeting. They made it harder on themselves to do so for a couple reasons. The one is market participants often read a pause as a stop, and the stop is the precursor to an ease. And so while right now there's expectation that they will tighten at the next meeting, it's already leaking from the futures market like a balloon. And unless the data are confirm the momentum to the economy, it'll leak further, and it'll be harder for them to raise rates. Moreover, they got to worry about the political dynamics of the policy decision. The pause essentially emboldens doves within your committee. They get to say, gee, Mr. Chairman, we really like what we did last meeting. Let's do it again. Moreover, you invite political pressure on your policy action. If I were on the staff of Sherrod Brown or Elizabeth Warren, Democrats on the Senate Banking Committee, I would have drafted by now a letter saying, thank you, Mr. Chairman, for the wisdom of keeping policy unchanged at your last meeting. It's already too tight. We hope this sinks in. We hope you don't raise rates anytime over the remainder of your career. That will make it a little bit harder to raise rates the next time. Basically, markets handed the committee on a platter the opportunity to raise the funds rate a quarter point, because in the middle of this last intermeeting period, that's where market pricing was. They could have done it and just get it over with, but they didn't.
So one more hike or two, not that one knows with such fine precision such things.
Yeah, so according to their dot plot, they raised the terminal funds rate for 2023 that they view as appropriate by a half point, and it's almost all of them think the funds rate's got to be higher. I think they'll do another quarter point in July. I think it will get increasingly hard that it's not that likely thereafter. So terminal funds rate a quarter point higher than where it is right now. I think in the scheme of things, a quarter here, a quarter there doesn't matter. That's why, even though I think it was a policy mistake yesterday by the FOMC, it's a relatively modest one that they can fix. I just wish they got the communication right, because it made it more difficult for them to fix that mistake.
Do you think that communicational issues surrounding yesterday's action, putting that to the side, do you think that the Fed has been communicationally successful, however, in beating back market expectations of cuts anytime soon?
They made a lot of progress over the last 6 to 8 weeks. For most of this hiking cycle, especially since October of last year, they lost the narrative to the market that everybody expected immaculate disinflation, and that the funds rate would stop rising and would be cut sometime in this year. They've gotten that pretty much out of markets, although yesterday didn't make progress in that regard. A little sense of future cuts came in. They just didn't convince markets. I think the problem is they try to make this all way too complicated. They've got a good story to tell based on the macro data on why policy has to be firm. They have firmed policy, but it isn't firm yet. The real federal funds rate is only marginally positive. Many indicators of financial conditions are easier today than when they started tightening because of what's going on in risk markets. They got to win that battle in convincing people that they'll hold the funds rate at a restrictive level for a considerable period. They made some progress, but they got more to do. And the only way they're going to do that is by demonstrating it. You just have to show your resolve to convince market participants of your resolve.
So how do you see the inflation picture? It seems as if core inflation is pretty stubborn and persistent, far above the 2% target. But others have said, look, it's going to take time. There have been substantial rate hikes. We need to let the monetary policy lags work. Expectations are well anchored. So where do you see inflation headed, and what drives that vision?
Yeah, so I think the biggest surprise to monetary policymakers was the sectoral nature of the pandemic shock. We told everybody to refrain from market activity. A lot of people did it voluntarily. Those who didn't had to do it because the government directed. Um, and the reality is, when there's a health risk to market activity, people will, do less of it. But that hit services a lot harder. Um, and it hit service supply harder than service demand, because it was service workers more at risk associated with COVID, and it was also more service workers told to stay home. Meanwhile, the government kept income elevated by very large federal fiscal transfers. You couldn't spend on services, just so you spent on goods. Goods inflation rose sharply, dislodging a 20-year trend in which goods inflation had been pulling down total inflation. We had the 30% of the price basket goods, which tends to adjust quickly, moving from a drag on inflation to something pulling inflation up. What happens is service inflation then struggles to catch up with where goods inflation's already been, because service inflation is much more about contracts, it's about social norms, it's about a lot of individual decisions made by people trying to figure out their relative position to their competitors. The plain fact is, you wouldn't go to a doctor or an accountant that had a chalkboard in the waiting room saying today's prices are the following. They just adjust slowly. So what's happened is goods prices did their adjusting up. They're now no longer contributing to inflation. Some are actually adjusting downward, but service prices have to catch up to all that goods prices have already done. And that's what makes inflation very sluggish. What do you need to do? You need a period in which aggregate demand is in better balance with aggregate supply, not an unemployment rate that starts with a 3, and it has to be for a sustained period. The test for the Federal Reserve is whether that prolonged period of restraint necessary to bring inflation down is too long. And you're going to hear people say what you did in the question. Made significant progress, connect the dots. It's a matter of time. Ultimately, inflation will go down. Maybe it's appropriate for the Federal Reserve to stop short of bringing inflation back to goal, given the favorable dynamics set in. And I think that's in our forecast that the Fed does cut rates next year, exactly on that logic. But that logic also sets the risk that inflation doesn't quite make it back to the Fed's goal of 2%. That the long period of time of inflation above goal just makes it salient to households, and it becomes part of the backdrop of making price decisions, making decisions generally, and we live with a little bit higher inflation. And I think that, among other things, is why Volcker and Greenspan defined price stability as a state of mind. It's a situation in which households and firms don't base their decisions on concerns about a changeable price level. We've lost that. The only way to get it back is a long period of demonstrating we're at price stability. I don't think the Federal Reserve will have the appetite to do that. They'll probably stop short. Inflation is going to be lower from here. Not quite going to get back to goal.
Thank you. Well, that raises a bunch of other questions, but we'll we can come back to. Just on the economists have been predicting a recession for a long, long time. It keeps on getting put out, delayed. Now, the payroll data, as you mentioned, has surprised to the upside, but good payroll data should support disposable income and consumption. So can inflation be brought down without a significant rise in unemployment? You alluded to this, but what's significant in your view?
Yeah, what's significant? And the answer is you need some policy restraint. The less policy restraint you get, the longer you have to stay at that level. So it's a trade-off between how tight you are and how long you're at that level of tightness. If if the Fed wants us to limp along at something a little bit below trend growth for a prolonged period, ultimately we'll probably get inflation back to goal. It will be harder because it will be harder to get households and firms' psychology about inflation to adjust when things are moving so slowly. I think that you've identified a couple issues, and so let's unwrap some of them. The first is this is a remarkably low productivity growth expansion. It doesn't feel particularly good. And that has a couple consequences. One is some areas of the economy have been in recession. It's a rolling sectoral recession in that regard. Gross disposable income has fallen for the last 2 quarters, even as GDP has been more uneven. Corporate profits have declined 3 quarters in a row. Lots of manufacturing activity is very sluggish. What's happening is we're getting a lot more service employment, a lot of low productivity service employment that gets us jobs, but not income. Ultimately, that's going to stop. But as long as the labor market is taut, then wage pressures will be higher. And as Chair Powell identified, those wage pressures translate into inflation.
Credit conditions, given the rate hikes, they should be cooling considerably, and conditions have become more restrictive, but there's few signs of a credit crunch even after the banking woes. There's concerns about commercial real estate. You already alluded to the fact that one can make the case that real rates are not at all that restrictive. So what's your take on credit conditions in the U.S. economy?
I think that also goes back to your previous question about the serial disappointment of economists in predicting the recession that didn't happen. First point is credit conditions haven't really tightened that much, nowhere near as much as you would expect from a 5 percentage point increase in the federal funds rate. Maybe part of the answer is it hasn't been that much, that as large an increase in the real federal funds rate, and it hasn't gotten really into restrictive territory, only just barely being positive. So part of the reason we haven't seen credit constraint in the private sector is the price component of Federal Reserve policy restraint has firmed a lot, but is still not that firm. I think the second part of it is the lingering hope that market participants have that inflation from here can be immaculate, that we can, get inflation, the Fed can get inflation back to goal and start cutting rates soon, has really empowered risk taking. And, risk markets have offset the financial constraints that the Federal Reserve has put in place. If we're officially in a bull market in equity in equity world, I've been told, well, it's hard to impose restraint on the economy when equity prices are doing so well. And then the last thing I would note is, while quantitative tightening officially started in June of last year, we really haven't seen much quantitative tightening in effective terms. And I think some of the economists' over-enthusiasm for predicting inflation, put it that way, has been expecting quantitative tightening to get traction when it really hasn't happened yet. Wait a minute, how can I say it hasn't happened? Since June, the Federal Reserve has stopped rolling over a lot of maturing securities and redeemed $750 billion of Treasury securities, of government securities. However, because of the debt ceiling constraint, the Treasury essentially paid for those redeeming securities by working down the cash balance. $750 billion of declines in the Federal Reserve's assets, $750 billion of declines in the Federal Reserve's liabilities because the Treasury worked down its cash balance, the Treasury general account. Explain to me how that's restraint on the private sector. If the government pays for itself, if the government moves funds from one pocket to another. So we really haven't seen the credit constriction associated with quantitative tightening because of other adjustments on the Fed's balance sheet. In fact, abstracting from the securities portfolio, the balance sheet got $300 billion larger because of emergency lending associated with those bank resolutions you mentioned. That's all going to change. It's all going to change right now. And that's because, freed from the debt ceiling, the Treasury is going to be rebuilding its cash balance. Meanwhile, the Federal Reserve will continue to shrink its securities holdings. Those official loans associated with bank resolutions will slowly unwind. And so assets, if anything, will be shrinking faster. The composition of liabilities will be shifting away from the private sector to the Treasury. So we're headed for a very quick turnaround in private sector availability of reserves and reverse RPs. And I think that's going to be associated with some credit constriction. So that my short answer to the long answer I've already given is, hasn't happened yet, but it's going to happen soon.
That's wonderful analysis, and I don't think I've seen much attention being paid to the dynamics of quantitative tightening, and that it may become far more impactful at this juncture. Well, let me throw one non-US question. There's tons of questions you've raised, but okay, so we first met when you worked in the International Finance Division, so I'm going to ask you a global question. It's about, so Europe, in my view, hasn't faced the demand side component of inflation that we did. They've had a much bigger energy shock. I'm not aware that second round wage effects are threatening to embed higher inflation. The euro area economy is stagnant. Inflation seems to be coming down. Yet the ECB rhetoric is hawkish. They've just raised another quarter point today. I'd be curious to hear any thoughts you have on ECB policy. And since you're such a global expert, let's throw in Japan, YCC, and a little China easing as well. Just any thoughts, quick thoughts on the other major central banks?
Going around the world in reverse order, we've had a below consensus China forecast for this year and view the latest easing by the PBOC as evidence of the concern. So, when you see policy action, the automatic response shouldn't necessarily be good news, the economy is going to boom. It's, oh my, I wonder why they felt the need to do that. And I think they feel the need to do that because of some deep-seated structural issues impeding growth in China and a cost associated with having taken one side in the global geopolitical conflict. And so we still remain below trend, below consensus on China. And therefore, that implies that China isn't the engine it was in 2008 and 9, helping to pull along global growth to the benefit of emerging markets and commodity prices when the advanced economies are faltering. Japan is a place where, after 3.5 decades, central bankers really need explicit demonstration that inflation has returned before they're willing to adjust policy. YCC, the yield curve controls, got to go first. One of the first requests from the Bank of Japan was for memos that went to that we prepared for the FOMC back in 2003, 2004 about how to do yield curve control, and those memos ended with the caution: when it gets old, you may wind up owning a lot of the securities, because if you try to put a cap on yields and markets don't like it, then you're going to have to purchase. And that's where they are now. We expect that with sufficient demonstration that the age of deflation is over, the Bank of Japan will move out of its unusually accommodative, unconventional stance of policy. You do it by loosening the bands of YCC, leading ultimately to it ending, but that's going to take a while. I think you're exactly right on the ECB. The euro area had global inflation, but it was much more because of its energy dependence on a unreliable partner, and so that supply element it has been going away as global supply chains heal and the energy market gets back into better balance, and there's an appreciation that global growth is slow. The problem for the ECB is its currency, and given their fear of floating, they do have to shadow Federal Reserve policy. And as long as the Federal Reserve is seen as tightening, the ECB is going to be leaning into that direction. I think the U.S. economy will be in recession. It's easier to have confidence that the euro area will be in recession.
Okay, let me turn to John, and again, audience, submit indications whether you'd like to be called on in the chat function. John, what pithy comments do you have for us for a few minutes on what Vince said and your thinking?
Well, I think that Vince and financial markets, unsurprisingly, are pretty well aligned in their assessment of the Fed. There is definitely, I think, the first point I would make really is that the markets have been willing to second guess the Powell Fed. There's a sense that at this point in the tightening cycle, there's going to be some performative, aspects to what the Fed is doing. And this was really coming into this to yesterday's decision. The sense among market participants was that a pause was pretty much cemented, but they would have to have some sort of hawkish surprise along with it, whether fire breathing language. But there was a lot of sense that the dots would be the vehicle for that hawkish surprise. Lo and behold, that's what we saw. 2 additional rate hikes. The markets, were looking a little bit askance at that as a realistic, noting a lot of the internal contradictions with the Fed's projections, its communications, its actions, what it's saying versus what it's doing, that Vince pointed out, and so ultimately the futures markets really didn't change that much. The base case had been for a sort of a last kiss goodbye rate hike in July and then on hold. As Vince pointed out, the communications progress that the Fed had made up into this meeting was largely about getting rate cuts priced out in the months that were almost, at one point as early as September, which would be a neck snapping pirouette. So there was, going into the meeting, a lot of those cuts were pushed out. The results of the meeting pushed those anticipated cuts out a little bit further. They increased the odds of a July hike, but overall the posture of investors toward the Fed outlook really didn't change all that much. So it ended up with a relatively gentle market reaction, and that fed through into risk assets. We saw an initial, that knee-jerk negative reaction in stocks, hawkish Fed, stocks go down, but they fought back. But when you look under the hood, not just yesterday, but over the past few months in stock markets, the rally has been it's broadened out a little bit, but to a great extent, it's been carried by the AI sort of mania. If you're looking at, Russell 2000, which is the small mid cap stocks, if you're looking at the Dow Jones, which tends to be a little bit more, real economy, if you're looking at an equal weighted S&P 500, that was, a couple of, week and a half ago, that was flat on the year. Whereas the index itself is up a lot with these concentrated and very sector specific gains. And so it's, from a headline, basically index level perspective, you can look at the equity markets and say, well, this is showing, a lot of optimism about growth and earnings and that sort of thing. But if you look under the hood, it's a much more nuanced case. And certainly, across the panoply of risk assets, if you're looking at commodities, again, these are not, showing a massive risk rally, and to sort of match the theme that's sort of coursing through the equity markets, which again, I would say is really driven by this, to a great extent, by this very specific sort of AI tech boomlet that we're seeing. Last thing I would say is basically from the market's perspective, where the rubber is going to meet the road for the Fed and the markets. If there's a collision course coming, it's going to be in the back half of this year, early 2024. If there's a recession or a more marked slowing of economic growth, and immediately those cuts that have been priced out of the Fed fund futures are going to come roaring back in. The first squishy non-farm payroll number is going to bring those rate cuts right back into focus for market participants. And I think that's going to be, where the Fed is going to have to really lash itself to the mast if they want to have that higher for longer. They're going to have to demonstrate to the market that applies even if growth deteriorates in a relatively meaningful way in the coming quarters. So that to us is sort of the potential sort of macro collision course that we're seeing between markets and the Fed in the back half of this year, perhaps early 2024.
John, do you think the Fed's overdoing it?
I would have said that I definitely would have said that earlier this year. I thought that the hiking cycle was abrupt, steep. I thought that they were running, they were sort of running from one side of the boat to the other, when instead of taking a steady course. But the proof really is in the real economy's resilience. I count myself as among those that were much more concerned about the real economy impact of such a steep hiking cycle. Now, of course, there are chapters still to be written, and and you don't want to discount the fact that a bunch of meaningful and systemically important banks fell over as a consequence of that. But the remarkable resilience of major parts of the U.S. economy, as Vince said, this is it's a checkerboard. There are areas of significant pronounced weakness, recession, and when you look at when you look across the panoply of different indicators, there's possibility of incipient weakness in a bunch of different places, and some hints of softness in the consumer. But all in all, if you told me the economy was in this kind of shape and credit conditions were in this kind of shape after that steep a trajectory of rate hikes, I would have been very surprised. And so, yeah, I was not correct.
Okay, that's only the first time you've ever been wrong.
The first for everything.